Granny Shots is kind of proving that the market is not maxed out because we're only buying large cap stocks and we're beating max. When you hear someone say the S&P is concentrated only 7 stocks, Granny is proof that that is a false argument.
All right, joining me will be Tom Lee, co-founder of Fundstrat Global Advisors, who's one of the top independent research firms on Wall Street. And of course, Tom himself, I think everybody knows who Tom is. He's a very prominent investment strategist with some 30 years of experience in equity research. He's also a regular CNBC contributor. But just last year, Tom and Fundstrat Capital, which is an affiliate of Fundstrat Global Advisors, they launched what is now one of the fastest growing ETFs out there with the Fundstrat Granny Shots US Large Cap ETF, ticker GRNY. Great name, great ticker. But listen to this. Granny launched in November of last year, November. It's already over $2.1 billion in assets. And I'll give you another stat, which is that out of 700 plus ETFs that have come to market since Granny launched, this ETF is now number 5 in inflows overall, which I would say is noteworthy for any issuer, but especially so for an independent issuer launching their first ETF. And so Tom and I will discuss the success of this ETF. We'll get into how he's managing it and what he's seeing in the markets right now. And then, since you all know that I cannot help myself, I'm also hoping to spend at least a few minutes talking Ethereum, because Tom was recently appointed as the board chair for BitMine, which is a Bitcoin miner, but I believe they're now the largest publicly traded holder of Ether. And so this is what you would call an Ether treasury company. And I'm going to try to sneak in at least a few questions on that as well. Now, to start this week, I am joined by Cinthia Murphy, investment strategist at VettaFi. And we thought with Tom on the show this week, and given the success of Granny, it might be fun to look at the most successful ETF launches over the past year and a half or so, really since the beginning of last year. And that's exactly what we're going to do. And so I'll now welcome in Cinthia. Cinthia, thank you for joining me this week. Okay, so we are going to go through the most successful ETF launches since the beginning of last year with one huge caveat, which is that we are going to exclude spot Bitcoin and spot Ether ETFs, because don't you think I've covered those enough?
I've been saying that for a long time, but I think we disagree on that, Nate. I think you can't get enough.
Well, I should note by successful, we're measuring that in terms of inflows. I think that's the cleanest way to look at that. But look, on spot crypto ETFs, real quick, let me offer up a few stats, and then we can get into some of the other launches. You can briefly comment on these stats if you want, Cynthia. But I think everyone knows how successful these have been. But you look, the top new launch since January of last year is the iShares Bitcoin ETF, IBIT. And this isn't even close. We're talking $58 billion in inflows. Number 2 on the list with $13 billion in inflows is the Fidelity Wise Origin Bitcoin ETF, ticker FBTC. Number 3 is the iShares Ethereum ETF, ticker ETHA, with almost $10 billion. And the bottom line is I could keep going here, but if we just look at the top 20 ETFs overall, 8 are either Bitcoin or Ether related. And then if I include the YieldMax MSTAR, the Strategy Option Income ETF, MSTY, that's number 4 in inflows. And then the Defiance Daily Target 2 times long MSTAR ETF, ticker MSTX, that's in the top 20 as well. So 10 out of the top 20 ETF launches since the beginning of last year are crypto related. Do you want to offer any comments at all? I mean, we can move on.
Sure. When you think about 10 out of 20 are digital asset crypto related, however we want to phrase that, I think it's important to remember that this whole category has a really unusual setup. So first of all, January of last year, It's a brand new category. I mean, in our lifetimes, Nate, we haven't seen the birth of a new asset class. So we lived through that. So that's an unusual setup. And then on top of that, that birth of a new asset class came on the heels of more than 10 years of fights with the regulators to get it done. So we've had more than a decade to talk about it, to prepare for it, to tell the story, to get excitement, to get pent up demand. So it was almost like, it's not like something came in the quiet of the night and then it slowly got traction. We've been like waiting for more than a decade. It finally arrived last year and boom, the demand was there. And then I think third, from a macro perspective, I mean, we're living in the era of questioning the permanence and the relevance of the US dollar in a way that we had never really done before. So I think there's just this constant noise around, is the dollar the future or the past? And Bitcoin and digital assets in general came into that space. So it's just like the perfect, most unusual setup for this category to take 10 out of 20 spots.
I love the way that you framed it. I think you're right. It really was the perfect setup. It was the perfect storm. You had pent up demand because we had talked about these for 10 or 11 years, ever since the Winklevoss twins first filed for a spot Bitcoin ETF. I think you're right, just in terms of more people looking at the country's debt situation and looking at the dollar. Obviously, you have the emergence of crypto overall. And so you had this confluence of factors that created this perfect setup. And I still think we have a long runway here. We'll see.
I will tell you real quick before you pivot, because I know you love crypto. In our alt symposium last week, we just asked folks, advisors about crypto, and you will love this stat. 50% of the audience said they are more likely and more excited now to look into crypto now the regulation has turned friendly. So I think, to your point, this is early days.
Yeah, I've talked about that a lot, that you look at the numbers this category has put up, the numbers that I just walked through, and then if you actually have conversations with advisors, and your data is backing that up, we are still very early in this entire thing. So I do think we'll be talking about this much more moving forward, but let's move on and put aside crypto-related ETFs. So the top two ETF launches since January 2024, again, if we exclude all of the crypto-related stuff, are both mortgage-backed securities ETFs. So there's one from Schwab, ticker SNBS, and then one from JP Morgan, JMTG is the ticker. Does that surprise you at all? When I was running the list, I wasn't expecting to see MBS there.
It honestly did. I had to go look it up, like, why mortgage-backed securities? So I think a couple of things. I mean, the fact that one of them is JP Morgan, I think, tells half the story. Anything JP Morgan has touched since they got into the ETF space has just been a tremendous success. So there's a lot of reputation there, a lot of expertise there. But I think the mortgage-backed securities, we haven't really looked too much into it, but, it's delivering a lot of yield relative to treasuries. The spreads got really wide there, post the interest rate cycle that ended about 2023. Nobody else was refinancing mortgages. It got really high. So supply issuance of MBS got tight. Spreads were wide. And from everything that I've read, advisors I talked to, folks were kind of underweight MBS coming into 2024 and 2025. And so I think it's part of a broader story, which we've been picking up on, and a lot of these launches tell you the story, which is this pursuit of income that has taken many forms beyond bonds. And I think MBS just was, perfectly placed, delivering a lot of yield and potential for the time being. So maybe it was just that great timing on those launches.
I think you're right. I think great timing. And then I think we should recognize having these launched by issuers such as Charles Schwab and JP Morgan, big names, lots of distribution. Clearly, that's helped in terms of visibility here. Okay, the next couple on the list are both option income strategy ETFs. So the NEOS NASDAQ 100 High Income ETF, ticker triple QI, and the Yield Max Ultra Option Income Strategy ETF, ticker ULTY. And to me, this one, option ETFs have clearly been popular. I mentioned MSTY earlier. Here are two others. Not really a huge surprise, right? Just given what we've seen over the past few years.
Yeah, I think, Nate, it's been again this income conversation. Folks have looked for income elsewhere beyond bonds, beyond dividends. The derivative income category is huge. I think if you look at just within active ETFs, derivative income is the biggest asset gatherer from any other active type of category, from defined outcome, from large caps, from ultra short bonds, from any other thing. Derivative income is the fastest growing category. So I think we just, in the ETF world, learned how to use options, and now we can't get enough. It's like behind crypto. That's the one thing that's on fire. It's this use of options, and it delivers these. The distribution yields are eye popping. These numbers are so high, and so folks you can't launch them fast enough, apparently.
The funny thing is, you may recall, I do these 5 ETF predictions every year, and back in January of last year, I call this entire covered call ETF space or options-based income space a bubble. And it's only gotten much, much bigger. Just a poor prediction on my part. I was either way too early or just completely wrong, which I guess is the same thing. But this space just continues to amaze me because we continue to see more product come to market and the audience is there. And I don't know that that's going to change.
I think a lot of the amount of assets sitting in derivative income and ultra short bonds today within active is just, it's a really interesting story, how it's income plus income in different paths, all under active managers. It's been fun to watch.
Okay, next on the list is an ETF that I would say has caused a little bit of a stir, and that's the Simplified Government Money Market ETF, ticker SBIL. So this has taken in over $2.6 billion in just a few weeks. And if you look at why that is, the reason is because Simplify is using this for the cash management sleeve in several of their other ETFs where they have to hold collateral because they're investing in futures and those sorts of things. But they're charging a fee for this, 15 basis points. So they're charging their normal fee on the other Simplify ETFs. And then if they hold SBIL and those ETFs are charging another 15 basis points. Any comments here? We don't have to get into that entire debate if you don't want, but clearly the reason this has the assets that it does so early is because they are using it in their other ETFs.
Yeah, I mean, I understand some of the drama, if you are a Simplify investor and you used to have part of your portfolio's cash managed and now you're paying another 15 basis points for an ETF to replace that. You may not be happy about it. Well, pick up your phone, call your investor relations desk, call the desk and talk through it. You're their client, figure it out. I think, broadly speaking, we're looking at a money market ETF, which is a brand new category in the ETF space. As you know, there's only like 4 or 5 ETFs in this category. That is now massive, and it is the cheapest. And I think price is an important innovation in ETFs. So from a product innovation perspective, given the amount of money that keeps going into money markets in general, almost $8 trillion today, money market funds and people parking cash trying to figure out what to do, to bring to market a product that is the cheapest in the category and now, has enough also asset mass to look like it doesn't have any closure risk. It's interesting for other investors. So I think it's a positive.
Yeah, I think that's a great point because if you look at the money market ETF category right now, we have Texas Capital is out there. iShares has a few. I know some of the other issuers have filed as well. But to your point, this is currently the lowest cost ETF out there, 15 basis points. And if we just take a step back and compare that 15 basis points to what you see in money market mutual funds, it's a fairly sizable difference on average. And now that this ETF does have the 2.6 billion plus in it, so lowest cost on the market, it will be interesting to see if that attracts, additional investors from outside the Simplify complex. But I think you're right. I think we do have to acknowledge they did launch this as the lowest cost product. I won't wade into this entire fee debate around whether or not they should be waiving the fee within the other Simplify ETFs or not. We'll stay focused on the positive aspect here, which we have a 15 basis point money market fund. Okay, I am going to lump a bunch of other ETFs together. So again, these are all in the top 20 of inflows for new launches since January of last year. So the ones we haven't touched on, the Vanguard 0 to 3 month Treasury bill ETF, ticker VBIL. In Vance, they actually have two ETFs in the top 20, which might surprise a few people. So there's a total return bond ETF, ticker EVTR, and a floating rate ETF, ticker EVLN. And then the iShares AI Innovation and Tech Active ETF, ticker symbol BAI. That's also in the top 20. Anything standing out to you here at all?
I would just say to me, it's two different things. One, V-Bill is that cash management, ultra short bond story. Those funds in general keep gathering assets. V-Bill is the latest to come to market and gathering assets as well. The other one, BAI from iShares, which is an AI fund, not especially unique. There's a lot of AI funds. I think it's a distribution story. It really ranked up because it got put into the models. I think the ETF model portfolios is a big story. In ETFs that hit a big model immediately finds an asset base that's significant. I think BAI it's a distribution story. I think the Invest funds also. I mean, Invest has a huge expertise in fixed income. They're doing what they're good at, so that's great. But they're also part of the Morgan Stanley, footprint. So I think it's just broad reach from the get-go. And at the end of the day, it's access, right? So these ETFs are coming to market. They're meeting demand, but they're also broadly accessible and distributed. So it's that results into large numbers in that asset base.
One thing that's interesting to me, just as we've gone through the top 20, we still have one more to get to, is again, if we put the crypto ETFs aside, think about how many fixed income, or if we talk about the option income ETFs on here, there's really not a lot of pure equity ETFs. We mentioned BAI would be one. Does that surprise you at all? Just given that if you look over this time period that we're covering, equities have done extremely well.
It's probably because all the money in equities has gone to VOO and SPLG. So it's, and if you look at all these top 20, aren't they? I think they might all be actively managed. Maybe VBIL is not. I have to go double check. I don't remember. But all this, the active is shiny in parts outside of just broad US large cap for the most part. And
well, the only ETF that we haven't touched on is on the equity side, and that's the Fundstrat Granny Shots US large cap ETF, ticker GRNY. And I'm certainly looking forward to visiting with Tom Lee here shortly. But any thoughts on that? I mean, that has been a huge hit since it launched last November.
yeah, I think that ETF is super cool because it captures a lot of different things we've seen in the ETF space. The first one is celebrity. I mean, it's Tom Lee. The guy is like household name, big past as an institutional analyst, huge loyal following. This is what it looks like when somebody people want to invest like and want to follow launches a product that democratizes access to that expertise. So I think this is exactly that kind of thing when we talk about influencers, all these different ways people try to package that. I think Tom Lee is the best example of that working to perfection. It's an access story to his thinking, which is what folks are looking for. I think the last thing I'll say that I think really works well here is that Tom Lee and his firm, I mean, if you look at their content, their education is so good. So they are really committed to being out there, being super transparent, telling that story and engaging with the advisor, the investor audience. And all of that is just really translated into huge success. So well done for that.
It's so funny you mentioned that. That's actually something I want to ask him about, because you're right. I mean, clearly, Tom himself, he's well known. He has a large following. He's always out there, but they haven't just rested on that. They're really making a concerted effort, they being Fundstrat, to your point, get in front of advisors and investors. They are doing these monthly webinars, and actually, I think there's weekly videos that they're doing as well. I mean, they're really making an effort to get out in front of advisors. And I think that's what you have to do. We're over 40, 400 ETFs out there now. And if you're going to launch a product and stand out, people have to know about it. And you have to think about how to do that.
To that point, I think Eric Balchunas just tweeted this morning or posted this morning and said since the beginning of 2024 to today, 70 new issuers have come to market, not ETFs, issuers. I mean, think about the task of standing out. It's huge. And I think Tom Lee has done it right. Fundstrat has done it right. So congrats to them.
Well, Cinthia, fun chat this week. Great to see you. And thank you for joining me.
My pleasure. See you next time.
That was Cinthia Murphy, investment strategist at VettaFi.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Trader designs ETFs for sophisticated investors looking for leverage on the daily, monthly, or quarterly performance on stocks and ETFs. Leveraged ETFs involve significant risks. Consider the investment objectives, risks, and charges and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information which should be read carefully before investing, visit our website at traderetfs.com.
I'm now joined by Tom Lee, co-founder of Fundstrat Global Advisors, who of course is one of Wall Street's top independent research providers. And Tom himself really needs no introduction. We're talking about one of the most widely followed macro strategists out there. He's been providing research on the equity markets for some 30 years now. He's also a regular CNBC contributor. But Tom decided to bring his experience and expertise to the ETF space, into the ETF Terror Dome. And so Fundstrat Capital, which is an affiliate of Fundstrat Global Advisors, they are behind one of the fastest growing ETFs, the Fundstrat GRNY Shots US Large Cap ETF, ticker GRNY. Tom is, of course, the portfolio manager on that, and he's now joining me from New York. Tom, it is a pleasure. Welcome to the podcast.
Thank you for having me.
All right, so I want to start by giving you a stat, which you may or may not be familiar with, but I thought you might like hearing this either way, which is since your ETF launched last November, there have been over 700 ETFs that have come to market, over 700 new ETF launches. Out of those, your ETF is number 5 in inflows with over $1.9 billion. And of course, if you add in the performance of GRNY, which has been excellent, and we can talk about that if you'd like, you're now past $2 billion in assets in about 9 months. And so to start, I'd love to hear why you think this ETF has resonated with investors so quickly.
Hi, Nate. Yes. Well, foremost, thank you for having me on. It's great to have this conversation. And I think that GRNY Shots ETF resonates with folks for a couple of reasons. One is I do think it was just very familiar because GRNY Shots was originally a research portfolio of Fundstrat. So in 2019, we launched GRNY Shots, which was this idea that the biggest driver of the stock market are really themes, like in the 80s, it was this boomer entering the workforce and it was a retail stocks did best, the retailers. And then in the 90s, of course, it was the internet boom. And that was something Gen X's understood. And that was all about the build of the infrastructure and the services that came out of the internet. So GRNY Shots, in 2019, we launched it saying, look, there are 3 or 4 key story arcs to the stock market over the next 10 years that we want investors to understand, but then we want to pick stocks that are linked to at least 2 of those themes, because then you're not putting all your chips into like AI or cybersecurity. We're saying a stock that straddles both worlds is probably a better play. So I think that familiarity helped. And I think the second thing that really helped GRNY stand out was that I do think the market is looking for what we consider to be a sort of a thematic approach to investing. We're simplifying because we're saying we don't want to just chase Palantir, and Palantir is a granny shot, but we want you to understand that Palantir is not just about AI, but it's providing essential security, but it also happens to be tied to easing financial conditions. So it's like people understand what we're doing. And maybe the third thing that helps is we do publish a weekly video on our website, and it provides a lot of transparency because I think it gets anywhere from 30 to 50,000 people to watch it every week, and it explains what's happening to granny shots. So I think people feel like we're being very transparent about the approach.
Okay, so several things I want to follow up on there with what you just said. First, going back to the research, obviously, again, you've been effectively running this strategy for a long time. What made you decide to bring this into the ETF arena? Why bring this into an ETF wrapper?
Yes, there were several reasons. Fundstrat has a large community of subscribers and family users. It's about 400 hedge funds and 10,000 RIAs and family offices. So it's a large community. And many folks really liked the simplicity of the granny shots, how we explain it. And it doesn't trade a lot. We only rebalance every 3 months, and we still do. But they found that the rebalances themselves was a bulky process because that involved them, it's 35 stock portfolio roughly, and they have to buy and sell. So in a way, we thought it would simplify the process for them, and it's tax efficient by creating an ETF, because now instead of them personally doing the rebalances through our research driven process, we're essentially making that a little easier. And again, at the core, Granny Shots is a research first stock portfolio. It's not no gunslinger here, no one making factor bets. It's literally evidence-based research on the key themes, and we're buying the strong stocks.
By the way, do you want to explain the name of this ETF, the Granny Shots ETF? That's certainly a unique name in the fund world in general, not just in ETFs.
Well, the original research portfolio was called Granny Shots, and it's a tribute to Rick Barry. Granny Shots refers to an unconventional way to do a free throw, which is underhanded. Most free throws, well, actually, in the history of basketball, the original free throw was a granny shot because it's the correct physics way to shoot. Fewest moving parts of your body, and therefore you have the highest chance of success. Rick Barry popularized this. He was an NBA Hall of Famer, made 90% of his free throws using a granny shots. An overhand free throw shot has less than a 50% chance of success rate. Rick Barry was a 90% hit with his free throws.
I love that. I should have used that methodology back when I played basketball. I always shot overhand, which I was pretty good at it, but I probably could have been a little bit better. In terms of the strategy underpinning this ETF, you walked through it at a high level. You mentioned Palantir. Can you give maybe another example or two of key themes right now, and then perhaps tie that down to the individual stock level as well? Like basically explain how you're expressing these themes through individual names.
Well, we spend every year, the start of the year, thinking about, are the themes that we have in place still things that will be 5 to 10 year stories? Because we start with this idea that we're not trying to find the stock that works the next week or the next day, but really the arbitrage you have in the stock market is time. So we want to find the most powerful things that last 5 to 10 years. And so at the moment, the fundamental themes are things like what we call global labor shortage. Believe it or not, since 2018, and we wrote a white paper on this, the world has had a shortage of prime age workers. Now, we studied that since 1930. Whenever there's been episodic shortage of human prime age workforce relative to population, it's always resulted in a technology boom. It happened in 1958 to 67, 1991 to 99. The third one started in 2018, and it's not set to be in balance again until 2035. So this is the largest period in history of structural labor shortage. And that's why we have an AI boom. A second theme, and I won't walk through all 7, but a second theme that we've talked about is originally was the idea of energy security, that we thought the world was going to have a shortage of actual access to sustainable power. Now, again, we wrote about this in 2019, and lo and behold, it's become more acute today. There's huge shortages of power plant capacity everywhere, especially because of data center growth and now electrification and clean energy pursuits. We've added cybersecurity to this as well, because the idea that AI and tools and technology have made it harder for protecting companies' proprietary secrets, but individuals as well. And if you ask us how that's evolving, our team's been thinking about this, and we realize that energy security and cybersecurity are probably parts of the story of sovereign security. And so I think that that's one way our granny shots will evolve in the next 3 to 5 years, is to incorporate, as long as we can model it properly and identify the correct stocks. But I think sovereign security is now one of the key differences. But that's an example of our sort of way we derive themes. And then a stock, we create separate stock lists for each theme. We have to put a lot of paper, go to the library. It's not like you Google it. We find the companies that are most central to those themes. Now, again, it could be because they're playing a role in policy. It could be because they're big spenders. It's not always that straightforward. But the existence of them on a single theme does not make them a granny shot. They have to be tied to 2 separate story arcs, because we believe that's how you get a higher probability of the stock working. And I'll give you an example. During the internet boom of the 90s, the top internet stocks gained 1,700%. So $1,000 turned into 1.7 million. But if you bought a basket of every internet stock in 1999, you only had to be finding 8% of the winners. Your success rate only had to be 8%, and you outperformed the S&P. But imagine if you took 5 themes and you only had an 8% success rate. Then you have a 40% success rate of picking a monster stock. That's what we're doing with granny shots. We're saying, if you buy AI and you make a basket of AIs, maybe 10% of those will be winners. But imagine if you do cumulative probability. You buy 5 themes, but the stock is tied to each theme. Your cumulative probability actually is the sum of the 8%, not 8% times 8%. So, and I think it's showing up in the results, because granny shots year to date is up 18%. And it's outperforming the momentum index, MTUM, ETF, and S&P's up 7.4%. So we're already adding 10 percentage points to return, or 1,000 basis points, by this approach that by adding themes together, and a stock is in multiple themes, you're getting a higher cumulative probability of a successful stock.
As you walk through that framework there, one question that I have is there any particular reason why you're sticking with large cap stocks? Because it seems like you could make the case that some of the themes that you're identifying, if you're correct, there are smaller cap names that could stand to benefit as well. So why stick to large caps?
Yeah, well, it's a great question. So maybe at the start, granny shots is kind of proving that the market is not maxed out, because we're only buying large cap stocks and we're beating Mag 7. So like when you hear someone say the S&P is concentrated only 7 stocks, granny is proof that is a false argument. That really is people who decide to be structurally bearish and not realize there's plenty of great stocks out there. Because, granny owns JP Morgan, American Express, Axon, it owns Caterpillar. They're not Mag 7 stocks. So that's why we started with large cap. But to your point, Nate, we also at Fundstrat have run the SMID granny shots research portfolio, which is SMID cap. So it's non-Russell 1000. That's actually also massively outperforming the broad indices. And we are getting the same questions. Well, people now want us, they're like, Tom, we're tired of rebalancing your SMIC grannies every quarter. Would you consider doing this as an investment product? And so I think that you're asking exactly the right question. One of the things for Granny that we're watching is, we're not on any major investment platform yet because we haven't crossed the 1 year anniversary. So we have no previous investment product. So we've been having to grow Granny Shots and Fundstrat Capital with basically our arms tied because we're not on Morgan Stanley or Bank of America. In fact, a lot of people say they try to buy Granny through their Merrill Direct and they can't purchase it. So we're literally restricted on most platforms. So once we hit the 1 year is when the investment platforms could consider adding us. And then I think it makes sense for us to expand our menu of offerings because we know people can access. But we've been dealing with a lot of frustration. People are like, well, Tom, on my, Merrill Direct or whatever, I want to buy Granny for my IRA, but we're not even allowed to. So I don't want to extra frustrate people by introducing SMIC Granny and they can't buy that either. So, hopefully we get everything lined up, but I know those things take time. So we just have to be patient.
In terms of growing Granny and finding that audience, you were alluding to this earlier, some of the education that you do. I actually talked about this in my previous segment. Look, Tom, you obviously do a lot of media. I mentioned that you're a CNBC contributor. You do a lot of other stuff as well. And so I think clearly you do a nice job of getting the word out on how you're viewing financial markets. But to your point earlier, you also do a weekly video where you're basically communicating your investment thought process at any given point in time. And you're explaining your security selection. I know you do monthly webinars and those sorts of things. Why is that so important to you? Because I'll tell you, not every issuer does that.
Yeah, it is a lot of work. So we're doing it not because we think it's easy for us, but we think it's very important. Fundstrat's core mantra is really we're trying to help investors understand what's happening in the stock market so that they can make better decisions. We started our business 11 years ago focusing on institutional investors. And I think we've changed a lot of the ways institutions invest. But now we're trying to demonstrate a process to a broader audience because, as you know, people often have to fight their own instincts because the market can be confusing. They see a headline and they want to sell. And we preach this idea that unless it's going to change your thesis, you shouldn't do anything. And it really came into play during the tariff Armageddon that happened in April. People were obviously very concerned because the world had its Cuban Missile Crisis moment. And we thought it was extremely important, especially in our videos. Granny, we covered a lot of the macro saying, look, markets, when they have a waterfall decline, and if you don't have a recession, it's always a V-shaped recovery. That we said we would recover all the losses from February to April before the end of the summer. And then someone would say, well, why would you have a recession? Because that would come up in the comments of the video. And then the next week, we explained that the high yield market was barely reacting to tariff Armageddon. So it's hugely improbable that the U.S. was actually barreling into a recession. So now, Granny was under a lot of pressure, but we thought it was important to help people anchor what we were saying on the macro side, Fundstrat research to how the Granny holder should react. And then we've had a lot of folks thank us because they realized that we had that V-shaped rebound and we kept them sane through the process because we explained to them why history showed it would be a V-shaped recovery. And of course, it was a very difficult time for us and everybody because no one likes to see the market fall 20% literally in a month. But we also knew that was going to be a symmetric recovery. And while people were angry at us, now that we look back, that's exactly what happened.
I want to very briefly ask you about Ethereum, but before I do that, just to close the conversation on Granny, And obviously, Tom, there are a lot of different types of investors with with different goals. We're not here to offer any sort of investment advice, but I'm assuming you view GRNY as something that could occupy the core of a portfolio. Is that correct?
Yes. In fact, that's why granny shots makes sense as a word, because like whenever I write research or I'm on CBC, I always think of my late father, and actually I want to make sure whatever I explain is understandable to him. My dad was a doctor his entire life. He never understood investing, but I figured whatever I say, I need to make sure he understands. So the idea that we want whatever we do to be clear enough that someone who's worried about their grandmother's portfolio could feel confident we're managing and we're explaining what we're doing. Because if you don't understand what we're doing, then you can't trust us. And so that's why Granny Shots also is an appropriate name.
I love that. That's perfect. Your grandmother has to understand Granny's approach. That's perfect. Tom, I know we're a bit limited on time here. If you don't mind, I just want to briefly ask you about Bitmine and Ethereum, because I feel like you've made a lot of headlines here recently. And for people who are unfamiliar, a little over a month ago, you were appointed board chair for Bitmine, which is a Bitcoin miner. And I believe I saw yesterday, if I have this correct, that company is now the largest publicly traded holder of Ether. So this is what you would call an Ether treasury company. Do you want to just explain this to the novice? We don't have to get into the weeds, but what are you attempting to do here?
Yes, I'm be glad to. Again, going back to the history of Fundstrat, we look at story arcs and really important thematic drivers. And in 2017, which is more than 8 years ago, we published our first white paper on Bitcoin. And Bitcoin was under $1,000. And at the time, we wrote that we believed Wall Street was going to discover Bitcoin. Now, Bitcoin was already discovered by a huge community of other people, but we said Bitcoin was going to be discovered by Wall Street because for two reasons. One is that it represented the digitalization of a lot of what the financial system accomplishes in storing value. And the second part of that was that at a minimum, we thought it would become digital gold. And that's what I call like the Bitcoin moment, because as you know, the narrative around Bitcoin as a substitute for gold or a store of value has really flourished. And, Bitcoin's now 120,000. So our Fundstrat clients that we recommended a 1% allocation to, that has now become more than 100% of their holdings, just from that small bet on Bitcoin. And as we fast forward to 2025, as I look at crypto, which has become really relevant, there's a different moment that's happening this year, which is that it's from the combination of the Genius Act, which is the White House says, not only does the U.S. want to be leading in AI, they want to be leading and transforming the financial system onto the blockchain, because AI and financial systems meet on the blockchain. Like in the future, we have to control all this AI with tokens that run robots, and you secure it on a blockchain. And Wall Street at the same time wants to move the dollar and money markets and real estates onto the blockchain because it actually saves costs. It's actually super efficient. So the Genius Act is essentially saying it's safe to do. But the blockchain Wall Street is choosing is Ethereum. Ethereum is a legally compliant, and it's the second largest blockchain after Bitcoin. But it's been kind of left in the dust for 5 years because the only thing people cared about for the last 5 years was digital gold, which was Bitcoin. But now I think Ethereum is having its 2017 moment, like the moment that we're realizing AI and Wall Street are now meeting on the blockchain and they're choosing Ethereum. JP Morgan's building their stablecoin on Ethereum. Robinhood is tokenizing private equity and stocks on Ethereum. There has literally been no bank that is choosing tokenization that is not choosing Ethereum. It is very clear to the United States that a compliant legal blockchain is Ethereum. So to me, that's the biggest macro trade in the next 10 to 15 years is Ethereum is where Wall Street financializes, but also where AI is financializing. The projects that Sam Altman's working on that are cryptocurrencies are built as layer 2s on Ethereum. Everyone's choosing Ethereum. So I think Ethereum is facing a moment just like Bitcoin was in 2017, where it made a 100x move. I think Ethereum, is going to be 20. Well, our model is that Ethereum could be, 50, 60,000 per Ethereum, and it's only 3,700 now, which is why the best way for someone in the equity world, because they can't, they need to buy a company. We decided to take BitMine and transform its working capital into an Ethereum treasury company. And as you correctly pointed out, we've in the 35 days since, we've turned it into the largest holder of Ethereum in the world, basically, with $3 billion of Ethereum. But that's Ethereum at $3,700. So if now we can grow how much Ethereum we hold, plus Ethereum goes up, that's the opportunity in a stock like BitMine, where I'm serving as chairman.
What would you see as the potential benefits of buying, say, BitMine versus spot Ether ETFs, which are now on the market?
Yeah, Nate, that's a great question. To give you some perspective, when we announced I was becoming chairman of BitMine, the stock was $4.25, and it held $4 worth of Ethereum. That was from the investment we brought in, $250 million of investment from Peter Thiel, Founders Fund, and the likes of Stan Druckenmiller and Galaxy Digital, etc. Today, or the last time we announced an update of the holdings, there's now $23 of Ethereum per share. So in 35 days, if you held an Ethereum ETF, 35 days later, you have the same quantity of Ethereum tokens. We've increased it by 23 versus 4. So we've added $19 of Ethereum per share. So versus an ETF, we're increasing your daily holdings of Ethereum on top of the upside. That's why MicroStrategy, which is a good case study for us, in August 2020, when they became a Bitcoin treasury company, the stock was 13 and Bitcoin was 11,000. 5 years later, MicroStrategy has gone from 13 to around 400. So it's risen by 30 times. Bitcoin has gone from 11,000 to 120,000. So of the 30 times return, 11 times is explained by Bitcoin going up. But the 20 times increase in MicroStrategy's price, so that 11 times is what you'd got if you had owned an ETF. But MicroStrategy has increased their holdings of Bitcoin from $1 to $227 a share. So that increase in Bitcoin explains more of the price rise than price of Bitcoin itself. So that's what these treasury companies are able to do, is to increase your holdings of Ethereum.
Tom, before I let you go, I'll end by melding our two conversations together. And the way I'm going to do that is by asking you, would you ever consider Ether exposure in the Granny Shots ETF? And you'd have to get a little bit creative with the structure here, but it's possible.
Yeah. Well, in the Granny Shots, MicroStrategy is actually in the Granny Shots portfolio, because once MicroStrategy was added to the NASDAQ 100, then its inclusion on a major indices made it relevant for us to now look at it. Its eligibility came into play. And if there is an Ethereum company or company focused on Ethereum that ends up on the NASDAQ 100 or S&P, then within Granny Shots, that company would be eligible. But in the meantime, I would say that it's probably much more likely that in the SMID Granny Shots, which is small mid cap, you'll find more pure treasuries. Similar Scientific, which is a Bitcoin treasury, for instance, is in the SMID Granny Shots portfolio. Now again, but SMID Granny Shots is not an ETF. It's still just a research portfolio for Fundstrat clients. But eventually it should be, it very likely becomes an investment product.
All right. So for the purpose of our conversation, let's just say longer term, the goal here, let's get BitMine into the S&P 500 or the NASDAQ 100. And that solves the problem. You can have Ether exposure in Granny. Tom, congratulations on all the success so far with GRNY. I certainly wish you continued success, and I greatly appreciate you taking the time this week. Thank you for joining.
Yeah, thank you, Nate.
That was Tom Lee, co-founder of Fundstrat Global Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Rob Thummel, Managing Director and Senior Portfolio Manager at Tortoise, who recently expanded their suite of energy-focused ETFs. And quite simply, Rob is one of the sharpest minds in the energy space overall. So look forward to that conversation. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.